We're also joined by Suman Bery, the Vice Chairman of the NITI Aayog. We'll get to him in just a second, but we were just discussing this, and one of our guests pointed out that perhaps the budget may not be the appropriate mechanism to address this issue of what is happening in the stock markets, and something that both regulators have alluded to. Here is what the CEA, the Chief Economic Advisor, is saying when it comes to retail investors rushing into the stock markets. It says the financialization of economies has not ended well, even for advanced economies. The global financial crisis of 2008 is an obvious example. Developing countries face debilitating crises when financial market innovations and growth run ahead of the economic growth. Goes on to say there is a significant rise in retail investors in the stock market, which calls for careful consideration, possibility of overconfidence leading to speculation and expectation of greater returns. The financial sector should expand at a pace that is in lockstep with economic growth. India can ill afford economies over financialization at this current development stage. Let me welcome to the program the Vice Chairman of the NITI Aayog, Mr. Suman Bery. Mr. Bery, many thanks for joining us. We wanted to talk to you about the growth assumption that the survey makes, but let me get you to address what we've just pointed out, something that the survey has highlighted, something that we've had both the Reserve Bank Governor as well as the SEBI chief also allude to over the weekend. Significant rise in retail investors in stock market calls for careful consideration. Possibility of overconfidence is leading to speculation and expectation of greater returns. The financial sector should expand at a pace that is in lockstep with economic growth. India can ill afford economies over financialization at its current development stage. What do you make of what the survey is saying, particularly on this front, Mr. Bery? And would you expect that we could then perhaps see some measures being brought in to cool things down?
Shereen, these were matters on which I used to take an interest, but they're not part of my current responsibilities at NITI Aayog. But just as a development economist, a few reactions, if I may. First, India has a much lower credit to GDP ratio than other countries, certainly China. And so I think gradual increase in financialization is a reasonable prospect. And how to create safe assets and how to make sure that the casino dimensions of markets don't overwhelm their resource allocation role, that is certainly what the joint actions of the RBI and SEBI are directed to, and I think we've been doing it fairly well. I would make one point, which is that, having been around at the RBI at the time when we abolished the control of capital issues and started opening up equity markets, we opened up equity markets, but not debt markets, to foreigners on the ground that they would bring discipline, and when they exited, if they exited in a rush, they would bear capital losses. What is happening at the moment, and I think this is the thing we need to prepare for, is that even as foreign investors, portfolio investors, head for the exits, now there are a lot of domestic investors, so as it were, the impact is not showing up on equity prices, and so there is a risk that less experienced, less professional investors will be left, as it were, carrying the can as the more experienced investors exit. So, briefly, we must aim for greater financialization of the economy, because otherwise, coming to something that the economic survey in Chapter 5 does talk about, we are not going to have the depth to finance our increased investment requirements, and that is going to have to come domestically. So that's a good, not a bad. India could in time even be a provider of financial services to the world if the world becomes safer. But there are short-term issues that the regulators need to keep track of.
Yeah, Dr. Bery, thank you very much for that. I nevertheless want to add to what Shereen has said about the stock market. Shereen, actually in page 64 of the report on financialization of markets, the CEA goes on to say that India's market capitalization has seen a remarkable surge, and market capitalization to GDP ratio is now surpassing that of other emerging market economies like China and Brazil. And that's where he says, and I'm quoting from the report, it is essential to strike a note of caution. The market capitalization to GDP ratio is not necessarily a sign of economic advancement or sophistication. Financial assets are claims on real goods and services. If equity market claims on the real economy are excessively high, it is a harbinger of market instability rather than market resilience. Now, this is not really going to FNO. He's only talking about the stock market, the cash market surge. And even over there, he's pointing to instability. And then, of course, goes on to retail participation, not just through mutual funds, but also outside the mutual funds. I just thought I'll add to what you pointed out.
No, absolutely. But let me bring Mr. Bery back into the conversation. Mr. Bery, let's talk about what the survey now suggests as far as growth is concerned. And by all accounts, on the lower side of what other private forecasters are forecasting at 6.5% to 7%. And the 6 priority areas that the survey has highlighted, which the government as well as the private sector need to focus on in order for us to be able to get that sustainable 7% plus kind of growth rate to achieve the Amrit Kal objectives. Your take on the growth roadmap as well as the fiscal roadmap that the survey alludes to?
Yes. Well, first, the survey coincides with our findings at NITI Aayog, which is that for at least the last couple of decades, we have ups and downs. We have maintained a long-term average growth rate of 6% already. And that is, I think, very impressive and speaks to maturity of institutions and maturity of a decision-making structure. Now, the question or the distinction I want to draw for your audience is between the 6 or 7% that you and your earlier commentators were talking about for the coming year and the kind of growth that we are concerned about and thinking about Viksit Bharat. Broadly speaking, short-term cyclical fluctuations are driven by short-term demand, including demand from abroad, exports, and what have you. But when you have 6% sustained growth over 20 years and more, I'm talking about pre-COVID, obviously, this reflects developments on the supply side, and more detailed work that has been done by the RBI and I think by the World Bank as well suggests that actually it's been a reasonably healthy growth story, with productivity increase playing quite an important part. Indeed, when I was chief economist of Shell and I looked at India, amongst other countries, the thing that struck me is that India is a pretty balanced economy. We don't have, except for one area, fiscal, which you raised, and which I'll come to, namely that we don't have large current account deficits. As the economic survey notes, our growth-inflation trade-off has, in recent years, been better than the pack. So the point I'm making is that in the issues that arise in Chapter 5, which is financing longer-term investment, largely domestically, what is it that we need to change, or what is it that needs to change on the macro side, quite apart from the micro issues that the survey raises. So, I think 7%, I would say that the overall tone of the survey is commendably balanced, sober. It's not a rah-rah document, and I don't think it has been for the last couple of years, but still, we see ourselves as aspiring to becoming an advanced economy in the next 25 years. And so the questions are, what does that take on the supply side? And I think we'll get some answers to that in the budget tomorrow. I hope that the budget will pick up on some of the themes of the economic survey, which I think are very well chosen and very succinctly put.
Okay. Dr. Bery, I just wanted to ask your own view, or NITI's view, as a macroeconomist. The survey is only looking at 6.5 to 7, and they actually point out that FY10 to FY20, that is pre-COVID, the average has been 6.6, and that is why they are looking at 6.5 to 7. Do you think they're being too conservative? Do you think that it would be better? RBI's estimate is 7.2 for the current year. Do you think that you would have given a higher target or a higher forecast?
As I say, enough people, including those people on your panel, follow these, as it were, cyclical things. So I think the underlying question is, longer term, can we aim to up the 6.5 to 8? And what would that take? And there are discussions of that in the economic survey, with which I agree. A lot of it has to do with energizing the MSME sector, having a skill development agenda which is more impactful, remediating some of the shortages of skills and human capital in our university graduates. Look, I mean, the fundamental is very clear. This is an Amrit Kal because of our labor force, our demographic dividend. India's essential asset are its human resources, as was the case with Korea, to some extent was the case with China. And the question is do we have a machinery that is able to get the most out of these human resources at rising levels of productivity? A lot of that labor is, I wouldn't say trapped in agriculture. Indeed, it's now the case that for rural households, agricultural income is a smaller part of their income. But the fact of the matter is there are productivity gains to be unleashed if our human resources, both current and prospective, can be better matched to new opportunities. That's the long game, and if we get it right in a more complicated world, I do think that we can aim for more than our historical 6.5, 7. So another way of putting it is all that is happening geopolitically around the world a reason to lower our domestic ambitions? And my answer would be, I don't think so.
Well, speaking of, what is happening globally, and here's an interesting take from the Economic Survey, Dr. Bery, and I wanted to get your comments on that, on dealing with China. And the survey is essentially calling for a review of India's strategy on FDI from China. In fact, it says, will China +1 result in total movement of trading relations away from China? This may not be the case. Take, for example, nations like Mexico, Vietnam, Taiwan, and Korea, who've been direct beneficiaries of US's trade diversion from China. It says India faces two choices to benefit from China +1. It can integrate into China's supply chain or promote FDI from China. Among these choices, focusing on FDI from China seems more promising for boosting India's exports to the US, similar to how the East Asian economies did in the past. Chinese companies invest in India and then export the product to these markets rather than importing from China, adding minimal value and then re-exporting them. Your view, Dr. Bery, on the call for a review as far as the China strategy is concerned?
Well, we share a common border, unfortunately a contested border, with the second largest economy in the world. Okay? Mexico shares a border with the largest economy in the world. Now, it is certainly unfortunate that for reasons that we have no control over, that there are diplomatic issues with China. And it is unfortunately also the case that some of these, if you like, disagreements have arisen because of the very large economic gap that has opened up between us and China. The question now is, and it's an important question, it's a question even the great United States is grappling with, how is it that you benefit from being a neighbor to a technologically sophisticated and substantial market on your border without losing strategic autonomy? I think it can be done. This may not be the best time to do so, but I think over the longer run, one should be looking to a future where the Indian and Chinese economies are perhaps even more integrated than they are, noting the fact that after the US, I think I'm right, China remains our second largest trading partner. And the question is, I know NITI has not explored what it would mean to delink ourselves from China, to demote its status amongst our trading partners. I think I just happened to glance briefly at the economic survey, but if I heard you right, there is a concern about being part of value chains that end up in China. I think that's a reasonable concern, and I think that that was one reason why India chose to go a different direction of higher domestic value added and not being part of global value chains. And I think this was probably also one, although not the only reason, why we chose finally to back away from the RCEP agreement when we did. However, let me point out make two other points, if we're not out of time. First, let us be clear that our services sector is already a very important part of global value chains. The so-called global capability centers, the GCCs, what is that other than being a part of a global value chain? And let me also say that both with Prime Minister Modi's visit to the US, the state visit in 2023, and and the External Affairs Minister's very energetic diplomacy with Europe, with the creation of IMEC, that there are value chains directed to the West that we should be exploring and making sure that our domestic policies and our domestic lobbies, to be honest, don't prevent us from being part of those value chains.
Fair point. I think that is what the survey is suggesting as well. But Dr. Bery, before we let you go, at this point in time, we will of course know what the fine print of the budget looks like tomorrow. But is there a case to your mind that there be a higher number as far as private capex is concerned over what the interim budget had suggested? Is there a case to do more to provide sweeteners to the salaried class by way of tax SOPs? I just want to understand from you where you believe there is a legitimate case for the government to spend some of the additional fiscal cushion that it is now provided with.
Shereen, my only response to that, I mean, I am a taxpayer and I have a vested interest, but I would just say that firstly, I mean, they talk of a review of our policy towards China. For a long time, review of our direct tax code has been pending, and what better time than the start of a fresh administration, a new government, because I think the compliance dimensions of our tax code are very, and not to mention the GST as well, these are high burdens compliance, not just the incidents, on our MSME sector. So if, as the survey rightly argues, jobs are to come from the private sector, and much of our private sector is in the MSME area, I think simplifying the tax code is frankly more important than giving away SOPs, although I know that will be all of the attention in the pink papers when once the budget has been presented. And there was a direction of change, and I think it hasn't, which is that indirect taxes are regressive. Direct taxes, if paid, are a way of getting progressivity. And so if we can return to a steady path of, on the whole, with higher tax ratios, moving from indirect to direct, I think that's the direction in which policy should move.
All right, Dr. Bery, we will leave it there. Appreciate you joining us here today to help us make sense of the economic survey. We look forward to speaking with you tomorrow when the Finance Minister presents her 7th consecutive budget. Appreciate you joining us here on CNBC-TV18. That is the Vice Chairman of the NITI Aayog, Dr. Suman Bery. Well, a quick check as far as the markets are concerned. At this point in time, you've got the Sensex down by over 100 points, 109 points, and the Nifty Bank is just flat at the moment. We are going to take a break and return with the market coverage and more analysis of the economic survey. Don't go anywhere. We're back in a moment.